So welcome to our next session, which is a presentation by Dr. David Siska on how to price and risk manage derivatives, researching and teaching mathematics at Edinburgh University, more specifically mathematical finance, stochastic controlling games, stochastic partial differential equations, and theory of machine learning. He's also a member of the founding team and lead quant at Vega. And if you don't understand what most of those things are, don't worry, neither do I. I think we will learn more now. And if you have any questions during the presentation, please write in the chat and we will get right, or David will reply. Thank you. And right. I'm going to have today.
Thank you, Christina, for the introduction. So when Dagan said, I'll give a comprehensive talk about pricing and risk in 30 minutes, I was thinking that that's quite ambitious, but nevertheless, that's what I'm trying. Of course, you can spend then, well, as long as you like, really, on making these things more general, more complicated, and more correct. And, people do, and they spend their lifetimes doing that. But we'll see what we can do in half an hour. So what I'll talk about is just a little bit of what you've heard in the previous talk about futures and options basics, and then I go to actually how you price these, and for that you need this big assumption, which is an assumption of no arbitrage. We'll talk a little bit about that. Then we construct a no arbitrage argument, which quickly gives you price for futures. And then we move to pricing options, which is in a way a lot more exciting, because for options you always need a model. And the models can be very complicated, and we'll get to the complicated ones as well. But the simple one, really, I would like you all kind of, to say, okay, I know how to price an option in binary tree model. It's actually not that hard. You have to solve two linear equations. So, after this talk, you will be able to say, I know how to price options. And then if time permits, I'll talk a little bit about risk and how it's all related to what came already and what will come later. So first of all, a derivative is effectively any financial asset where the price is derived from one or more underlying assets. So think of a future or an option where the price directly depends on an underlying, or you can think of other derivatives. So for me, it's really important, which Tamlin already said, that a derivative is a promise, and when someone gives you a promise, you have to trust them. So you have this thing called counterparty risk, which is the risk that whoever gave you the promise actually won't have the money, in this case, when the time comes to pay up. And part of the reason why we had the 2007-2008 financial crisis was because a lot of institutions forgot about counterparty risk. So they had all their managed derivatives positions, and then when things started going bad in one sector, if one bank goes bad and then they can't keep the promise to you, then that means you also go bad. So counterparty risk is quite important. So of course there is a whole zoo of derivatives. Today we'll focus on futures and options, but then there are contract for differences, there are interest rate swaps, credit default swaps were already mentioned earlier, there are credit default obligations, and then many more are being invented because different risks can be managed with different derivatives. And each of these derivatives then comes in many flavors. So, for options, you will have the basic, what type of payoff, whether it's European style or American style. Each of these can be call and put. And then, Asian is a little bit how the underlying goes in, whether it's at a single point in time, which is what happens in American and European options, or whether you do a bit of averaging, which you might want to do. And, a lot of possible options. The nice thing is that there are certain basic principles which make all of these work the same, and we'll look at some of those. So probably most of you know what a future is. I'm going to repeat anyway. So it's a promise where one side promises to buy an asset at a future date for an agreed amount. So you agree the asset, which is the underlying, and you know the price today, we will call it ST in what comes. You will agree the future date, which is the maturity or settlement date, and you agree the strike. And in the previous talk, I think someone mentioned payoff diagrams. So this is what a payoff diagram is. This is on the y-axis, you have the payoff at maturity, and on the x-axis, you have the price of the underlying in relation to strike. So if you think that the strike is 100, and at maturity, which is the future date, the asset actually happens to trade at 100, then the payoff is 0, because you can buy something for exactly the same price that it's trading in the market, and so it's not very interesting. But if the price, if you're long a futures position, if the price of the underlying goes up, it goes to 200, say, why then? Well, your profit is 100, because you just bought something that's worth 100 for 200. And indeed, this is kind of a basic principle in futures, and you can have cash settled futures or physical delivery futures, and quite often the cash settled do the job, because you're really only interested in this difference in price. And the other diagram is the payoff diagram for a short future. And the fun thing about short futures is that your potential loss is unbounded. So if I bought a short future for, let's say, Tesla back in February for expiry on something like 1st of September, I could have lost a lot of money, because the price for some obscure reason went up and up and up. So that's the bit about, being careful with derivatives and understanding what they can do in different situations. So being short a future can be dangerous. I mean, being long a future can also it's a, as a mathematician, I think of it, at least it's a finite number. Here I can go all the way to infinity. So that's futures. Now, options are actually not that different from futures, and we'll just modify, what we agree, what the promise was. For a future, I promised to buy it at the price that I agreed, whether it was a good deal for me or not. An option, I'm buying the right to buy the asset, but I don't have the obligation. That's for a call option. And for a put option, it's sort of the other way around. I'm buying the right to sell the asset, but I'm under no obligation to do it. And you see, here are my payoff diagrams. So if I buy a call option, once I've paid the option premium, my payoff is always positive. At that point, either I get nothing if the price goes below the agreed strike, or here I can get potentially unbounded positive payoff. And for a put option, again, if the price goes above the strike, I get nothing. But if the price drops to below the strike, I'm getting my payoff. So that's all good, I bought the option. I had to pay the premium, which is the option price. We'll get to option prices in a moment, and then I can only win. And as they mentioned in the previous panel, if you sell an option, what you basically do is you will flip these charts along the x-axis. So it will be the same, but now it will go down, 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 down. And again, it's unbounded. So, if you sell a call option to someone, you collect the premium up front, but you're opening yourself up to a potentially unlimited loss. So that's quite a dangerous thing to do. So that's options. So let's talk a little bit about, how can we price these derivatives? So the first thing to understand is the idea of an arbitrage. So, there are more precise definitions of arbitrage than this, but the idea of arbitrage is that somehow you're making riskless profit by trading in the market. And, the most basic arbitrage is, you can make the trade and you make a profit, but, there are more subtle forms of arbitrage where you say, well, I've got this trade, I have a positive probability of profit, and I have zero probability of making a loss, right? So I can make the trade, I can try it as many times as I like, and eventually I'll win. That's also an arbitrage, but not as strong as saying I make a profit every time I do this trade or this sequence of trades, because typically you need to do a bunch of things. For example, buy something on one exchange and sell it on another exchange. Right, and then all derivatives pricing is done with this crazy sounding assumption which says that there are no arbitrage opportunities in the market. And of course we know that's not true. There are arbitrage opportunities in the market, and there are a lot of people keeping themselves busy trying to exploit these arbitrage opportunities. And as soon as they discover it, the prices move in reaction to them trading, so they close the arbitrage. And the idea is that typically these get exploited so quickly on the time scale of seconds, then when you're thinking about derivatives that have time scale of months, the arbitrage doesn't matter. If you go back to thinking about the short time scales, then you might have to start thinking about arbitrage again. So once you sort of digest the no arbitrage assumption, it gives you two related ways to think about derivative pricing. So the first observation is if there is no arbitrage, then it immediately follows that two assets with the same future cash flows must have identical price today. And the other thing that follows, and it gives you another way of thinking about derivative pricing, we'll have a look at using both, is that, imagine I put some derivative contract to trade in a market. So I start with a market where just the underlying is trading, for example, the price of oil, and I claim that there is no arbitrage in the market. And now I say, right, well, let's put an options contract on oil into the market. Well, if there is no arbitrage, then it must have a very specific price, and that price is the one that does not introduce arbitrage. And both of these ways, they're related, but they can be independently used to establish what the price of a derivative should be. So no arbitrage. That's the workhorse. Without it, everything falls apart. So let's have a look at futures. So remember, futures contract is where I agree to buy something at a future date, which is capital T, for an agreed strike, which is capital K. So let's say that I sold a long futures contract. In other words, I agreed to be the one who delivers the underlying asset and receive the strike amount. So how can I replicate the payoff of a futures contract? Because once I've replicated the payoff of a futures contract, I go back to this 1.1 and say, well, if I've got a portfolio which exactly replicates the payoff of the futures contract, then the initial amount that I need in this portfolio must be exactly the price of the futures contract, because otherwise there would be arbitrage in the market. So let's construct a portfolio, and we are working in a very naive world, because otherwise all the reasoning gets very difficult. So we just say, well, I can borrow the money from the market. I can borrow money from the market as much as I like. And so I borrow the price of the underlying from a bank. So let's say the underlying is 100 today, so I borrow 100. Now I go to the spot market and I spend the 100 and I buy the underlying asset. And then let's see what happens at time capital T. Well, at time capital T, I deliver the asset, that's gone. I receive K, and I have to repay the bank, right? Otherwise, we're working in a simplified world, but not completely crazy. It's crazy to say that I can borrow an arbitrary amount, but it would be completely mad to say that I then don't have to repay. So I repay the bank, and there is this exponential with R, which just says, well, there is some interest rate. the time went from little t to capital T, and with some interest rate, I have to repay the bank a little bit more if the interest rates are positive, which is not a priori a given. Right, so what does that give me for the price of the futures contract? Well, at the time of settlement, I've received K, and I paid what I borrowed with interest back. And then, of course, an equivalent to get this amount of money actually at time little t, I just multiplied by what's called a discount factor, which just tells me how to take the interest rates back, right? Because if I've got this amount at time little t, then over time, because of this interest rate, it will actually grow. It will actually grow to be this amount at time capital T. So I arrive at this point, and I say, exactly this is the price of my futures contract. That's the fair price. And if you throw away the interest rate, if you say that the interest rate is 0, you will see that it's exceedingly simple. The fair strike for a futures contract is just the current spot price. So the one interesting thing here is, from a modeling or mathematical point of view, we made some assumptions. We made assumption of no arbitrage. We made assumption that we can borrow and lend money at the same interest rate. We even made an assumption about what interest rate look like, right? We said that they are continuously compounded with constant interest rate. But one thing that we didn't need to do is to have a model for how the underlying asset behaves. We didn't need anything complicated, no trees, no stochastic differential equations. There's no arbitrage argument would work no matter what the underlying does. So that's futures price from no arbitrage argument.
So we have a question here. How do you price futures when you can't hold the underlying, for example, with power? And then a second question is, can you explain the difference between an option and a future contract?
Yeah, so to answer Tamlin's question, if you can't, well, okay, so if you can't hold the underlying, I'm actually not sure. You could quite easily generalize the argument that we had here to include something like storage costs. So maybe you have to actually, it's not a piece of paper that you buy. It's really barrels of oil that you buy, and then you could throw storage costs into the no arbitrage argument, and everything will work the same. If you can't hold the underlying, I don't know, Tamlin, you traded power futures, so you might have to tell us either now or later. It's interesting, never thought of that. And I'll go to explain the difference between an option and a future contract. So we go to futures. For a future, you agree to buy the asset at a future date for an agreed amount. And that's it. So I can agree to buy, I don't know, Bitcoin in December for $10,000. And, $10,000 sounds a little bit cheap, so probably I will have to pay someone a little bit of money to enter that contract with me. But after that, if Bitcoin goes up, let's say to 15,000, then I win $5,000. And if Bitcoin goes down to $5,000, that I would have lost 5,000, I am out of luck. For an option, it's very, very similar, but I have the right to buy, but not the obligation. So if I have an option to buy Bitcoin at $10,000 in December, and Bitcoin in December is actually trading at $15,000, so I'm somewhere here on this diagram, then I say, great, I've made $5,000. But in the opposite case, if Bitcoin is trading at $5,000, I say, oh, well, I've lost the option premium, but at least I didn't lose the remaining $5,000. So that's the difference. for a future, you have to go ahead with the trade. With an option, it's an option, so no obligation, right? But no obligation. Right, so let me carry on. So if you were to trade futures on an exchange, they would typically trade, so the numbers on the price you would see on a futures exchange is this fair strike, which always makes entering the contract worth 0 when you enter it. And it's given through this formula. And again, if you throw away the interest rates, it's just that the fair price is exactly the price of the underlying. And the contract is worth 0 when you enter it, but of course it's on an exchange, so we have a margin. And I do have this example on the slides, but it's slightly contrived, and I am a little bit short of time, so I'll skip it. And we move to option pricing. So to price an option, you have to come up with a model for how your underlying moves. So maybe it's a binary tree. You say one day it goes up, then it can go down and down again. Or you do something in continuous time. So you write something which is stochastic differential equation, which is effectively just differential equation with noise thrown in. And then, there is again a whole zoo of models, and, you can make them better and better. But finally, the truth is that all models are wrong and some models are useful. So that's, always a thing to bear in mind. Every model you take is wrong. If the model captures the essential phenomena of the world, then, it's useful. If you get this wrong, then you can lose a lot of money. So let's take the simplest possible model for stock price move. So let's say we have a call option where we agreed that the strike is 100, the initial asset price is 100, so we would say the option is at the money, and I have the simplest possible view of the world that, from now to the maturity, the price can either go up to 120 or it can go down to 90, Is this a reasonable model? No, of course not. It's a model, but it allows us to do a fairly simple calculation. So the payoff of the option, how much money I get at maturity, if the price went up, then I get 20 because I exercise the option. I buy the asset for 100, I immediately sell it for 120, and I made 20 profit. So that's payoff, and U stands for up, for in the case when the price went up. In the price, when the price goes down, well, I can buy something worth 90 for 100, but I don't have to, so I'm not going to do it. So in that case, my payoff is 0. So we've got 100, which is the price now, that's a 0. We've got the price, that it could have gone up in our model, the price it could have gone down, and the two payoffs, 20 and 0. And then our aim is to find a portfolio that, if I start with enough money at the beginning and made the right allocation, then I will get exactly this payoff. So 20 if it went up and 0 if it went down. So I need effectively to find two numbers. One of them is how much of the underlying I should buy, and the other one is how much actually initial investment I need. Right, so that's what we have. We have the diagram that unfortunately now is gone, but effectively we need to choose how much of the underlying we buy, call that psi, and how much we want to borrow or deposit, which is, well, the initial amount that I put in minus all the money that goes into the underlying, which is however many units I bought times the current price. And then if I want to match the payoff of the option, then I would need to solve these two linear equations with two unknowns, and we probably all remember from school how to do that. And this is the actual calculation. I think you'll be able to do this yourself. I'm not going to bore you with the calculation. It turns out you need to buy 2/3 of the units of the underlying. So that's another assumption you have to make. You can buy fractional units of the assets, or you simply have to think, well, I sold 100 options, so this would be 200 over 300, and I round it to the nearest unit, and it works. And the option price turns out to be 20 over 3 US dollars. So a little bit more than 6, little bit less than 7 for something that can either give me 20 if I'm lucky, or 0 if I'm unlucky. So just solve 2 linear equations with 2 unknowns, and you know how to price an option in a one-step binary tree model. So that's quite nice, nothing complicated about option pricing. I wouldn't recommend going to the market with this, but it's a start in understanding. You understand the main concept because you know how to construct a replicating portfolio that gives you the payoff of the options, and because of the no arbitrage assumption, the initial investment in this portfolio has to be exactly the price of the option. One interesting thing that we would have noticed is that actually we didn't need any probabilities in the tree of moving up or down, and even if we gave the probabilities and then sort of calculated the expected payoff with some probability that we put in the tree, it wouldn't match the price from the no arbitrage argument, and we would have been wrong. So that's quite an interesting observation. And in fact, you can use this and say, well, there might be a probability measure under which it's just a payoff, and it just so happens that it's exactly the probability measure which allows you to ignore the up and down moves in your underlying asset. And the reason why you can do that is because the up and down moves, you hedge away with your hedging portfolio, so you don't care for them. So if there is a probability measure in which the underlying asset is what's called a martingale, which is effectively something that has got the same expectation in the future as it has today, then that would be the probability measure in which the derivative price is just an expectation. And we can do that with the model that we have. Here I calculate the expectation with Q. Q is my probability of going up, 1 minus Q is going down, and these are the 2 possible values that I can have for ST, and 100 is the initial price, so I solve this. So under the model, under the risk neutral measure where I say I've got 1/3 chance of going up, I can then say that the payoff of my option is just the expectation under this what's called risk neutral measure. And I've run out of time. How much do I have any more time, or should I finish now, Christina?
You do have to finish now, but we have 2 questions. So first, we have a quick math questions. Say the matrix securing from the linear equation is not invertible, then we cannot replicate the option. How do we price the option then?
That's a very good point. But you chose your model to begin with, right? You wrote it down. So if you write down a model that gives you something that's non-invertible, you just say that's not the right model, and you put, you choose a model that makes sense.
Okay.
And then the second question, I'm reading it, and
I'm going to read it out loud so we have it for the report.
Yeah, please.
So, Dr. Siska, do you think it makes any sense to use index options to hedge a completely diversified portfolio? Is there a way to make the math work well, not only in theory, but also in practice?
I have to say I've got no idea. I would have to, see exactly what the index option is and what the portfolio is, and then write things down. Too complicated for me to answer like that. I apologize. We can talk. We can talk later, Rafael, if you give me more details. It sounds like an interesting question.
We've also set up a designated channel in our Discord to talk and continue the conversation for all of this. Thank you so much, David. This was phenomenal. And then we have a tiny break before we move on to the next panel in a couple of minutes. That is DeFi is eating fintech and the role of derivatives in this new ecosystem.